Welcome to online lecture. This is Dr.P.Raji Reddy, Assistant Professor of Commerce, Government Degree College for Women, Konw. Today we are going to start the lecture on cash flow statement. As we know, cash flow statement is one of the important statement in financial statements. There are three statements are prepared in annual reports of any company. The three statements are mandatory to all the companies. Do you remember what the three statements are? Yes, number one is balance sheet, number two is profit and loss account, number three is cash flow statement. Balance sheet, it is a statement which shows the financial position of the firm, and it shows the assets and liabilities of the firm on a particular date. The second important financial statement is profit and loss account. It shows the profitability position of the firm. It's showing how much incomes, how much revenue generated by the firm, and how much amount belongs to expenditures. And the differences amount of these two is showing the net results of the firm. That is, it's showing the profitability position of the firm, whether the firm encourages the profit or loss, what it may be. It show the profitability position of the firm for a particular period of time. So traditionally, these two statements are very important statements, and also these two statements are treated as a financial statements. But after 1990s, another statements are included. With the help of balance sheet and profit and loss account, these two statements are not providing sufficient information to stakeholders. Shareholders are very much interested to know the cash movement of the firm. So that cash flow statement is a mandate to companies. So now we will discuss what is the meaning of cash flow statement. So cash flow statement is a statement which shows the inflows and outflows of the cash and cash equivalents of a enterprises during a specific period of time. So here cash and equivalents, cash inflows and outflows words are used in the above definition. What is cash inflows and what are the cash outflows? Cash inflows means that is a receipts of the cash, and cash outflows means payments by the firm. Cash payments by the firm, that is, inflows means sources and outflows means application of cash, uses of cash. So cash flow means that is inflow or outflow, whatever it may be. That is cash flow. So here cash means cash in hands and demand deposits. So here cash equivalents are refers to short-term highly liquid investments. So demand deposits, for example, if you are having saving account, saving deposits, current deposits, is also treated as a cash equivalent. But fixed deposits are there in a bank. The fixed deposits amount is not treated as a cash or cash equivalent item. This is one of the important thing while preparation of cash flow statement. Now we will discuss on classification of cash flows. Cash flows are classified into three categories. that is cash flow from operating activities, cash flow from investment activities, and cash flow from financing activities. So now we will discuss the one by one. The first important cash flow from operating activities, important one. Cash flow from operating activities is one of the important activity because it show how much amount, how much revenue generated by sale of goods and services. So here four items are mentioned in that slide. First two items which are related to cash inflows, and then after two items which are related to cash outflows. The major source of cash inflow of operating activity is sale of goods and services. And the second thing is receipts from royalty fees or commission and other revenues, what it may be. The major portion is only cash generated from sale of goods and services. Then the another two items which are related to cash outflows, which means the firm has to pay the amount to others, that is suppliers as well as employees. Here there are two methods are there to ascertain the cash flow from operating activities. The first one is a direct method. The second one is indirect method. How to find out the cash flow from operating activities with the help of direct method. So in direct method, first we have to find out the cash receipts from the customers. Then we have to find out cash payments to the suppliers as well as employees. The next step is to find out income tax amount and extraordinary items. So first we have to find out the cash receipt from the customers. So here, before going to calculation of cash receipts from the customers, we have to know the information about the sales, that is total sales. It includes cash sales and credit sales and trade receivables of beginning and end. With the help of this information, we have to prepare how much amount received from the cash receipts from the customers. First, we have to take the total sales amount, that is cash sales and credit sales, then add trade receivables at the beginning of the year less trade receivables at the end of the year. The coming result is known as cash receipt from the customer. So here very important thing while calculation of cash receipts from the customer is trade receivables. So trade receivables, it includes bills receivable and sundry debtors. The next thing is cash payment to suppliers. So for the purpose of calculation of cash payment to suppliers, we have the information, we have to get the information about the total purchases, trades payable at the beginning of the year, at the end of the year. Based on this information, we can easily find out the cash payments to suppliers. So here cash payments to suppliers is equal total purchases plus trade payables at the beginning of the year minus trade payable at the end of the. The next one is cash payments to the employees. So while calculation of cash payments to employees, First, you have to get the information about the total office administrative expenses figure. Then add outstanding expenses at the beginning of the year less outstanding expenses at the end of the year, and add prepaid expenses at the end of the year less prepaid expenses at the beginning of the year. The outcoming figure is known as cash payments to employees. So this is a procedure to get the amount of cash receipts from the customers and how much amount paid to suppliers as well as the employees. So then we can easily find out the cash flow from operating activities. So this is a way, this is a procedure to find out the cash flow from operating activities by direct method. Cash flow from operating activities with the help of direct method. The first step is cash received from the customers. Already we discussed total sales plus trade receivables at the beginning of the year minus trade receivables at the end of the year. Then cash paid to suppliers as well as employees. Already discussed. So take total purchases plus trade payables at the beginning of the year minus trade payables at the end of the year. That figure is reflects the cash paid to suppliers. And to take total administrative expenses plus outstanding expenses at the beginning year minus outstanding expenses at the closing year, end of the year. That is, and add prepaid expenses at the end of the year less prepaid expenses at the beginning of the year. That indicates the cash paid to employees. Step 1 is cash received from the customers, and step 2 is cash paid to the suppliers as well as employees. After deducting that amount, that cash paid to suppliers and employees from the cash receipts, the coming figure is known as cash generated from operations. Then less income tax paid, then the coming figure is known as cash flow before extraordinary items. Then less extraordinary items. Extraordinary items is these are non-recurring nature, unexpected activities, unexpected income, which are not regular type of income or regular type of expenditures. Lesser or add what it may be, then the coming figure is known as cash flow from operating activities. So this is a way to find out the cash flow from operating activities by using direct method. Then the second important method for calculation of cash flow from operating activities, indirect method. So indirect method, first you have to take net profit before tax and extraordinary items. Then add non-cash and non-operating items which are already debited to profit and loss account, like provisions for different type of activities like doubtful debts, general transfer to general reserves, preliminary expenses written off, and depreciation, amortization. Depreciations already you know is related to fixed assets, and amortization is related to intangible assets. And also loss on sale of fixed assets, loss on sale of investments. So these are all non-operating items and non-cash items which are already debited to profit and loss account. These are all added to net profit before tax and extraordinary items. Then deduct some of the activities, some of the items which are related to interest income, which are not related to operating incomes. That's why interest income, dividend income, rental income,